Hello, and welcome to our review of rebalancing your portfolio. In this short video, we will discuss what rebalancing your portfolio means and when and why we do it. First, though, we need to review the purpose of your portfolio's asset allocation plan. At AFT Trivest, our uniqueness comes in our approach to investing. We look at accounting, financial planning, and tax implications of your specific situation and create a customized investment plan that will complement the needs of you and your family. The style of investment we employ is something called asset allocation. This means that we apportion your financial assets among several classes of investments depending upon your age, net worth, life goals, and risk profile. Your financial assets are then apportioned a percentage to each asset class. These asset classes are cash, fixed income securities, Canadian equities, and foreign equities. The higher the need for short-term capital preservation and/or near-term income from your portfolio, the higher the percentage of your financial assets we manage with more conservative investments such as cash and fixed income securities. With a longer-term horizon and a tolerance for more volatility, we apportion a higher percentage of your investment portfolio towards Canadian and foreign equities. The first asset class, broadly known as cash, actually includes several types of financial instruments for investing, including cash, T-bills, and all other money market instruments. The next asset class is fixed income investments. These include government bonds, corporate bonds, GICs, strip bonds, and preferred shares. To ensure a smooth and stable stream of income, we employ a strategy known as laddering, which means that the maturity dates of the investments in your portfolio are staggered to mature over different points in time so that even if some of your investments mature at a time when interest rates are low, your entire fixed income portfolio won't lock in at the low rates. The reinvestment risk is therefore spread out over a period of 5 to 10 years, enough time for interest rate fluctuations to smooth out. At AFT Trivest, we view fixed income's role is more about capital preservation than its yield to maturity. The third asset class is equities. The broad purpose of equities is to grow your portfolio, and to do so with a broad diversification of all your financial assets, thereby minimizing risk. Investing in equities does involve a higher degree of volatility, so our understanding of your need for growth versus capital preservation and seeing how that might change over time is critical. Equities are a broad asset class and can be segmented both regionally, the United States, Europe, Japan, emerging markets, or by industries such as industrial products, consumer products, resources, utilities, financial services, technology, healthcare, and real estate. At AFT Trivest, we divide equities into two categories, Canadian equities and foreign equities. As the Canadian equity market comprises only 4% of the global equity market and is not particularly well diversified, with the majority of our market being weighted in resources and a few large financial services companies, we view foreign equity as an important asset class providing better diversification in the healthcare, consumer products, industrial products, and technology sectors. By understanding all your needs and risk tolerance, we establish your personalized asset allocation plan. To help understand how this looks, let's start with an example $1 million portfolio that has the following asset allocation plan. Cash, 1%, fixed income, 49%, Canadian equity, 20%, foreign equity, 30%, for a total 100%, with the values in dollar amounts to the right of that. As time goes by, certain asset classes will grow more quickly than others, thereby moving your plan out of alignment. Our role is to then rebalance your portfolio. We do this when one or more asset classes become materially over or underweighted in comparison to your asset allocation plan. When an asset class has a period of outperformance, as we have been recently experiencing in foreign equity, that asset class will become overweighted within your asset allocation plan and thus will call for a sell down of that asset class and the funds to be deployed to the asset classes that are now underweight. As an example, if after 1 year, cash was turned 0, fixed income 2.5%, Canadian equity 10%, and foreign equity 25%, that portfolio and asset allocation plan call would look as follows. Please note, we have rounded to the nearest percent. In this example, due to the outperformance of foreign equity, it has grown to 34% of the portfolio. The asset allocation plan calls for the sell down of 44,300 in foreign equity and all of the funds raised to be deployed to fixed income, as it has dropped to only 45% of the portfolio. This very important discipline forces us to take profits as an asset class enjoys its outperformance cycle and the deployment of those funds raised to the asset classes that are currently underperforming. This brings us to the age-old adage of buying low and selling high, one we all aspire to, but one that is not nearly as much fun executing as you might think. Selling high requires selling something that is doing well, and which generally has a positive consensus. Buying low means buying assets that have been doing relatively poorly and are currently viewed as out of favor. However, buying low and selling high is how value is created over the long term. It is important to note that the discipline of rebalancing is not about being positive or negative on a specific asset class. By rebalancing, we constantly maintain your portfolio at the asset allocation levels that were deemed appropriate for your individual situation. We will change your overall asset allocation plan if your individual situation changes. In this way, we hope to maximize your return while minimizing your risk. We manage this process because ultimately we want to deliver you peace of mind, and that's something that can help you sleep better. For more information on this and other investment topics, please visit our website, InvestorU, or contact us directly. Thank you.